Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, January the 30th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. A lot of that has to do with the economic picture and how that impacts the overall markets. Well, I do about the same thing here in these webinars and in market commentaries, where I talk about the economic data, how I see that impacting the overall markets, and once we come up with an assumption, how we can take options and implement that into a portfolio. So, without further ado, remember, past performance of any trading system or methodology is not necessarily indicative of future results. So let's get on with that economic data. Across the pond, the major thing we really saw was out of Great Britain. The Bank of England kept interest rates unchanged at 0.75%, which is lower than our interest rate right now. We kept ours yesterday with the FOMC at 1.75. One thing to note, Powell did speak after that release and signaled that if the market or if the economy tends to wane a little bit, then they were going to continue with this non-quantitative easing, which is what we've known them to have done since basically 2009. Now they're trying to put a different look on it, lipstick on a pig, if you will, to try and talk about it as non-quantitative easing so it doesn't have that same connotation. Well, that looks like it might be something that is closer than further down the road going forward, because we are seeing some signals of weakness here in the United States. So let's talk about the U.S. economic data points here in the United States. We got advanced GDP coming in line with expectations at 2.1%, but prices index did come in lower than expected at 1.4%. Now, know that the Fed is trying to artificially create inflation by printing dollars. That's that non-quantitative easing. Because when there's more dollars out there, people are able to spend, and that drives prices higher. The people that have the dollars can drive prices even higher, and we're not really seeing that happen, which is probably not what the Fed wants to see, but you know, it's a product of this quantitative easing really not doing that much at this point. People are so used to it for the most part. And as global economies are doing the same thing, it has a tendency to kind of offset one another. All right, so we also got unemployment claims, which isn't the most important number to look at. We're going to get that one coming up in February. But unemployment claims, this talks about the people that are looking for unemployment assistance, and that came in at 216,000, slightly higher than the expected 215,000. One thing to note, though, we did get a revision to last month's number, and they increased it by 12,000 from 211 to 223,000. Natural gas storage is expected to be a drawdown of 190 billion cubic feet. It actually came in a little bit higher than that at negative 102 billion cubic feet. So that means that people were using more. I think that has to do with it being in a winter month and, excuse me, gosh, and just using more natural gas. I don't think that's enough to really drive oil. As we can see here with the chart, we are seeing oil come off by another $1.13, breaking below that value area low, which we would expect to see a little bit less volume down here as price really isn't being accepted, right? Well, we're starting to see this whole picture shape up here in the United States and across the pond, that there is definitely some slowing of the economies, and therefore there is going to be a lack of demand for gasoline and distillates. Now, distillates being the major component that goes into the manufacturing sector, and when they break down this crude oil, goes into polypropylene and things of that nature, plastics. Well, there's not a whole lot of demand there if the economy is slowing and manufacturing starts to slow down. But we're also seeing on the other side, the consumer side, where we usually use the gasoline from those distilling products. And we're seeing that really start to build. That altogether is causing weakness in crude oil. And that's why we're breaking down below this value area low and near a support level in and around $50 a barrel, which is going to be a support that I think that it will hold. going forward. I don't think that we're really going to see that go much below that, because what happens when it starts going much below this 52 or even $50 a barrel is here in the United States, we have a ton of oil, but it is due to fracking, and fracking operations start losing money in or around that $50 a barrel area. So they start pulling back and shutting. They don't really shut down. They just basically go to a bare minimum production just to keep those online. It's a little bit more costly to shut down the fracking operations and then restart those up. They can't just completely shut them down. They just slow to a very minimum, and that will cause supply to come off a little bit. And you know, if demand remains constant, that should support prices for the most part. All right, gold is up, which is not unexpected here, up $11 with the equities starting to correct. We're starting to see some of those kinks in the armor for equities. We got bonds up another 25 points on the day. Another inversion. We kind of got out of that inversion for a very short time, but back seeing that inversion in the yield curve, which is signaling a recession going forward. Also, the bonds in the 10-year are really seeing that what the Fed is doing isn't working, and that is a signal that the recession is coming, and that what the Fed is doing is really not helping at all. All right, we've got the VIX moving higher, and that's why, because we've got the equities coming off. We can see the Dow Jones Industrial Average down about 160 points right now off the lows, but you can see we did make an attempt to rally right off the open, but that was short-lived, and as the day goes on, we're starting to see some more weakness as the market starting to correct a little bit. I would normally say that after this point in the day, the institutional guys have kind of done their trading for the most part. We start seeing some volume start slowing down in the later parts of the day. We see the retail investor come in, and we'll see a little bit more support. I don't know if the retailer is in that kind of mindset at this point. I think that they are in a mindset where they've seen a couple of corrections here and are looking to either cover some of their positive positions, the ones that they've made money on, or add some protection by buying puts, which actually is what's driving that VIX a little bit higher. So when you see that start to happen, we won't see that late day rally necessarily, and I think that we'll probably see more weakness throughout the day. E-mini S&Ps, similar situation, down 22 points on the day, well off the highs. Again, we did try and make a bit of a move to the upside, as you can see here on the open. That was very short-lived. This is a 30-minute candle, and you can see it actually gapped from this candle to this candle in that 30 minutes. So that was a pretty major drop. That's one of those reasons why I'm saying that weakness after that institutional buying kind of ebbed right off the open. We saw some weakness there and really just kind of fell out of bed. So if they aren't in there supporting it, I think that we're going to see more weakness throughout the day. And that was kind of the cause of that theory there. All right, let's talk about some trades that I've done. And the only thing I did, and this was yesterday, I went into Disney and got out of my short calls, if you remember. What I've been trying to do with this is I've gotten synthetically long in Disney. Clearly has not been working out, but when it stopped working out, I started getting a little bit more mechanical in that. And I am long at about 148. So I've been trying to lower my overall cost basis on that, which I've done consistently. I've lowered it by about $1.50 at this point. But I had sold the Feb 160 calls in there for $1.03. I covered them yesterday for 16 because I'm fighting against volatility starting to expand, which kind of hurts that position. Yes, the 160 handle is a good location, but I've kind of ridden this out for a while, and we're heading close to that earnings, and I don't want to be in it. I'm actually bullish on the earnings going forward for Disney, despite the fact that we have the coronavirus going on. That could hurt, but I don't think it's going to necessarily show up in this earnings report. they could come out with their earnings call and talk about forward guidance and that hurting them. And that could maybe offset some of the euphoria around a good earnings for Disney. But I think that their streaming service is doing very well, and that will show up in this data point. So that's all I've done so far. I didn't do any earnings. Got a little bit busy yesterday with some family stuff and didn't get around to getting those earnings trades put on. So, it is what it is. And that's about all I got for you guys. Check out today's webinar, though. We are going to be talking about the covered call spread, all right? So the covered call spread is similar to what I've talked about here with lowering your cost basis on just the short calls, but this will be great for somebody who is a little bit bearish on something, worried about a correction, say in something like Disney. Maybe there's some earnings coming up that you don't want to lose that stock. You don't want to take capital gains, but you still want to try and lower your basis if that assumption doesn't work out. So I'm going to talk about all of that in this webinar, all the strike locations, the type of environment we need in order to set something up like that for a good result. All right, so check it out at protraderstrategies.com, and if you can't take that, take it easy.